Two new stock market scams exposed. The stock market can be full of contradictions. On one hand, the Indian stock market grows stronger every year, helping more and more people achieve their financial goals. But on the other hand, it's also a place where a lot of folks lose big money, and not just because of bad investments, but also to scams. Hello friends, welcome to our channel Vishwakul. Today we will knowing about the scam going out in India, which is more of stock market scam. We have seen it all, from pyramid schemes promising double your money, returns every week, like the one that blew up in Assam recently, or scammers impersonating brands to trick people. Today, we want to tell you about two more scams that you should know about. Let's start with the first one. Imagine this, a company launched an IPO to raise money, claiming they will use the funds to buy some fancy software. But the catch is, that the software was supposed to come from a third-party vendor, which, as it turns out, was a shell company. The so-called vendor had zero ability to actually build or deliver the software they promised. And the unfortunate part is that investors didn't just buy into this IPO, they oversubscribed it by 345 times. So what exactly happened? Let us take it from the top. On May 31, 2024, a company called Trafixel Its Technologies filed for an IPO. They're in the business of making intelligent transportation systems, think traffic automation, toll management etc. They plan to raise about 45 crore rupees, with 40% of it, 17.7 crore rupees, earmarked for buying a software called Integrated Command Control Center Software, ICCC. This ICCC software is a crucial piece of tech for running smart cities and is typically imported from international vendors, because Indian technology is simply not there yet to deliver something like this. Fast forward to the subscription period between September 10 and 12. Investors went wild. Against the 45 crore rupees the company wanted, they poured in 10,000 crore rupees. But not everyone joined the herd. On September 16, just a day before the shares were set to list, a complaint landed in the inbox of SEBI and BSE. The complaint, filed by the Small Investors Welfare Association, Siren, flagged something fishy about the third-party vendor supplying this ICCC software. SEBI put the listing on hold and started digging. Investigation started and went on for a couple of months. SEBI sniffed around, issued show-cause notices, and pieced together what was happening. By December 3, they finally issued an order confirming that the vendor was in fact a shell company. The software vendor couldn't build the promised software, much less deliver it. At present, SEBI has ordered the company to return the funds to investors, along with the interest it earned while the money was locked up. The IPO is cancelled, and the shares will be cancelled. But what SEBI uncovered and how they figured out what was happening, that's some straight-up spy movie material, worthy of its own Netflix series. Who knows, maybe one day we will see a new series. Here are the three big problems SEBI uncovered during the investigation. 1. No operational capability. When SEBI checked the vendor's office, they found it locked and empty. Clearly, no business was actually happening there. On top of that, the vendor didn't have the skills or tools needed to create the ICCC software. This made it clear they couldn't deliver what they had promised. 2. Fabricated financials and bogus client list. SEBI discovered that the vendor's financial documents for all 3 previous financial years were created on the same day, strongly suggesting they were fake. Additionally, the client list submitted as proof of credibility was bogus. 2 of the 3 mentioned companies had never even conducted business with the vendor. These findings highlighted that the vendor existed only on paper. 3. Suspicious vendor selection process. The vendor and Trafixel were introduced by a middleman, with no open process to invite tenders or evaluate multiple vendors. The quote for the ICCC software was given before the two parties even met, and only after SEBI got involved did they actually meet. This suggests that the quote was likely fake and used to make the transaction look legitimate, pointing to a possible attempt to misuse the IPO funds. For now, the company is still off the rails. While the vendor has been exposed as a shell company, the bigger question remains unanswered: was this all a deliberate attempt to embezzle funds and siphon off IPO money? But there are plenty of questions to think about. Was there no background check done before getting a quote from the vendor? Or did the company know all along? Did Trafixel itself orchestrate this, and are now simply denying it? What about the merchant banker? Did they fail in their duty to conduct due diligence? And the CA who signed off on those suspicious financial statements, were they complicit too? Too many questions, but one thing is clear: SME IPOs, with all their buzz, have become a breeding ground for shady activities. This case is just another in a long string of issues that have surfaced, and it's likely not the last. For context, SME IPOs had already raised 6,300 crore rupees in free 24 to 25 till November. Could there still be more skeletons waiting to be uncovered? Now, if you thought the SME IPO scams are wild, let me tell you about another shady case that SEBI cracked wide open. This one is about a man known as Bap of Chart, a popular financial influencer who promised his followers sky-high stock market returns. It already smells suspicious to us. And if that isn't enough, check out the entry of this guy in one of his masterclass workshops. Well, he's good at making grand entries, but not so good at scamming people. SEBI's investigation revealed that he wasn't just giving free advice out of the goodness of his heart, he was running an unauthorized investment advisory service, collecting crores from unsuspecting investors. Here's how it worked. Under the guise of offering educational courses on stock market trading, he and his team provided direct buy, sell recommendations to their clients for a fee, of course. These weren't ordinary classes, they were packaged with promises of guaranteed returns, pulling in innocent investors who wanted to strike gold in the market. Over time, he and his 6 associates managed to rake in 17.2 crore rupees in fees. You know the funny part? This self-proclaimed stock market guru wasn't even profitable in his own trading. SEBI found that he concealed his trading losses while promising extraordinary returns to his clients. His flashy YouTube videos and social media posts were all part of the act to reel in more people. SEBI wasn't having any of it. After months of investigation, they banned him from the securities market for a year, with his associates getting 6-month bans. On top of that, they've been ordered to refund the 17.2 crore rupees to their clients, plus penalties. The lesson: if someone promises guaranteed stock market returns, run the other way. As SEBI tightens its grip on these so-called financial influences, it's a reminder to always verify credentials and think twice before following the hype. When it comes to money, there's no such thing as a shortcut. In the next story, we are diving into what might be the biggest disruption in healthcare and consumer behavior we've seen in decades: weight loss meds. Earlier this year, Morgan Stanley projected that the global market for obesity drugs like Ozempic could hit $105 billion by 2030. That's a 15-fold increase from today's $6 billion valuation. This is clearly much bigger than just a weight loss story. Let me paint you a picture of why this matters for people around the world and especially here in India. According to a study published in the reputed Lancet journal, we are facing a significant health crisis. 40% of Indian women and 12% of Indian men are dealing with abdominal obesity. In the urban areas, these numbers are even more striking. Nearly half of urban women face this issue. What's particularly concerning is how this varies by age. For women between 30 to 39 years old, about 49.3% have abdominal obesity, and this jumps to 56.7% for women aged 40 to 49. Now, drugs like Wegovy, Mounjaro etc. were originally developed for diabetes, but researchers started noticing some remarkable and unexpected effects. 2 groundbreaking studies especially have everyone talking. The first, from late last year, looked at over 500,000 patients suffering from opioid use disorder and more than 800,000 with alcohol use disorder. The findings were stunning. People taking these drugs had a 40% lower rate of opioid overdose and a 50% lower rate of alcohol intoxication. Then last month, an even more detailed study published in JAMA added fascinating depth to these findings. Looking at over 14,000 people in a weight management program, they discovered that nearly half of those who were drinking alcohol when they started these medications naturally reduced their consumption. What's particularly interesting is that this wasn't just a small change, the reduction was significant enough to have major health implications potentially. And here's the key part: these people weren't trying to drink less, it just happened naturally, suggesting these medications might be fundamentally changing how our brains respond to certain substances. But it's what Morgan Stanley's research is showing about food that's really catching attention. These drugs are completely rewiring people's relationship with food, particularly processed foods. Their surveys found that people on these medications are not only eating less overall, but half of them have drastically cut their consumption of sugary drinks, alcohol, and snack foods. Nearly a quarter stopped drinking alcohol completely. That's all for today. We will be back again with more such content. Do subscribe to our channel. Don't forget to hit a like button and share it with your friends and family.